AI just predicted the next global recession, and it's closer than anyone thinks. Not next decade, not even years away. We're talking about signals happening right now. Across the world, warning signs are flashing. Debt is exploding, growth is slowing, and financial systems are under pressure. But here's the twist. It's not economists raising the loudest alarm anymore. It's artificial intelligence. And what it's seeing could change everything. But how can AI predict something as complex as a global recession? And more importantly, what exactly is it seeing that humans might be missing? To understand what AI is predicting, we need to understand how recessions actually happen. Recessions don't come out of nowhere. They follow patterns. Take the 2008 financial crisis. It started with housing bubbles, excessive lending, and hidden risk inside the system. Everything looked stable until it suddenly wasn't. Then came 2020, a global shock triggered by COVID-19, which exposed fragile supply chains and over-leveraged economies. Across history, major recessions tend to share the same warning signs: rising debt levels, high interest rates, slowing economic growth, asset bubbles. And right now, every single one of these signals is flashing. Global debt has now crossed over $300 trillion. Interest rates are at multi-year highs. And economic growth is slowing across major economies. But here's where things get interesting. AI doesn't just look at one or two indicators. It analyzes thousands of variables simultaneously, from market volatility to consumer behavior to credit flows. And unlike humans, it doesn't rely on assumptions or emotions. It detects patterns invisible to the human eye. And right now, those patterns are forming again. AI models are detecting tightening financial conditions, declining liquidity, rising default risks, weak consumer spending. In simple terms, the global economy is under stress, but here's the part most people don't expect. The next recession may not start where everyone is looking. Not in the stock market, not even in housing, but in something far more hidden: the global credit system. AI is flagging a surge in corporate debt stress, particularly in emerging markets and heavily leveraged companies. And if credit starts to crack, everything else follows. Because modern economies don't run on cash, they run on credit. So what happens if these signals continue? AI models suggest a potential chain reaction. Credit tightening increases, businesses cut, spending, unemployment rises, consumer demand falls, global recession begins. Not all countries will be affected equally. Emerging markets, like parts of Africa, Asia, and Latin America, could face the biggest risks. Why? Because they rely heavily on external debt and global capital flows. But here's something most people don't realize. Recessions don't just destroy wealth, they create it. Every major downturn in history has been followed by massive opportunities. For those who understand what's happening, AI is not predicting the future with certainty, but it is revealing patterns. And those patterns are telling a clear story. The global economy is entering a period of uncertainty. The question is not whether change is coming, it's whether you'll be ready for it. If you want to understand the forces shaping the global economy, subscribe to Atlas Economics, because the future won't wait.